The banks can lend money. They can do whatever they want. Credit card companies can do whatever they want. But then we come in as people and we're like, oh, no, 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 no. You can't charge X amount for interest. You can't do this. You can't do that. What? 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 Why can they go do it? Why can payday people lend money at 30, 40% interest? I mean, it's just crazy. Like, don't tell me what I can and can't do. That's not going to go over well with me. Hello, and welcome back to the podcast. Thank you very much for being here. All right. Today, Teresa and I are back to talk about how the banks view real estate versus how investors view real estate. Because Miss Teresa has way more experience in this than I do, I'm just going to let her take the lead. And then, of course, y'all know I will have comments. So, Teresa, I'm going to let you start us out on that, and then I'll fill in where needed.
Okay, perfect. Well, thanks so much for having me again. I always get so excited to have these conversations with you because they sound like our phone call conversations. It's just everyone's listening in now. Or we hope they do.
That is 100% accurate. You guys can just pretend like you're, back in the day, you're probably too young, Teresa, but there were party lines, and you can hear... You don't know about party lines?
I do not, but it sounds like I should know about party lines.
Oh my goodness. Yeah. So there were party lines. And I don't know, maybe this wasn't a city thing. Maybe this was just a thing for the country kids. But we had party lines. And so my mom and dad's phone would connect with my grandpa and grandma's phone. So if my grandma wanted to eavesdrop on my mom, you could pick your phone up real slow and they wouldn't know. And you could listen in on a whole conversation.
Oh, okay. I think I am familiar. I just don't know if I call it party lines. Because we did have a landline growing up, okay? I'm not that green.
So it's funny because you could listen in. So that's like what y'all are doing. You're listening in on our party line.
Yes. Our a little bit more filtered party line. So let's get this party started. I love this idea because I think so much of infinite banking is like you have to... I always say this, it's a little bit cheesy, but put on your banker hat. It's like you have to think like the bank. How does a bank think about this transaction? Because what it does is it really grounds your thinking into, does this action make sense for me, or does it make sense for the bank, Mm-hmm. So I mentioned this one time and it really resonated with someone. It's like, how many times can a bank make money off of a piece of real estate?
A lot. They can make money every year.
Exactly. Unlimited times, right? How many times can that have a transaction? Unlimited. Because even if the house deteriorates or whatever, there's still land that can be financed at the end of it. So as a real estate investor, you think about something as, how can I have this investment make friends and come back to me? And typically that happens one time, right? If you purchase a home and you have cash flow coming from it, or you purchase commercial real estate and have cash flow coming from it, that's one transaction. And maybe you sell it. So maybe it's two. But meanwhile, the bank has been flipping that same piece of real estate and making their interest up front every single time there's a transaction on this property. So it's really unlimited. It's infinity, which is kind of fun to think about. The game of infinity, right? It's like they have a monopoly over the flow of money. They have a monopoly over the asset. And then they have a monopoly over how many times they can do the same transaction with someone different.
Mm-hmm. That's really a fun idea to think about. I've never thought about it that way. And if there's any of my farmers listening, it's the same thing with land, right? It doesn't matter if it's a house or if it's land or whatever it is. How often do people actually sell? So what's the reality of how often a bank actually does get to touch that property? Because do you know off the top of your head what those numbers are? I think the average person stays in their house 5 years or 7.
Right. Yep. And then they reset that same cycle over again.
So all you're doing is paying interest. And Nelson talks about that in Becoming Your Own Banker, that all you ever do is get the interest paid down. So not only is it infinite for the bank, but it's all interest.
Right. It's like banks don't take risk, they take collateral. So they're saying, hey, you're going to pay me my share up front. And that's going to be the majority of the payment. When you look at an amortization schedule, there's so much going to interest every single year
Mhm.
until you get down to the very bottom of that payment schedule. So it's just like, we have to think like banks do because they've figured it out. They're very smart. They're like, if I'm taking on most of the risk, you're giving me most of that payment up front.
Mhm.
And then if you want to resell it, I'm just going to make that same deal with someone else that wants to be a real estate investor. So that's why I challenge people to think like both people, be the real estate investor, but also think like the banker. How can you be the bank? How can you have unlimited transactions? And how can you make this thing work for you your entire lifetime? Because it's such an exciting conversation and it really challenges and expands your way of thinking about it.
I think there's a couple of things that I would add to that thought process is one, if you start thinking like the banker, if you're using the bank, because not everybody's going to be ready to use their infinite banking process to purchase that home, right? Our cash value is not going to be big enough in our life insurance, so we might have to do both. Some people in the real estate world are leveraging the bank and they're using the bank. And so some people go into the bank and they're like, oh, they're not going to give me any money. Well, did you go in prepared? Did you tell them what the cash flow on that rental property is going to be? Did you do your due diligence? When I finally got into a position where people asked me for money, I turned into a banker and I started asking really stupid questions like, do you work? Like, are you going to have money to make the payment on this? You and I have a colleague, Terry, that borrows money to people or lends money to people to buy homes. And he's like, well, how come that house isn't done yet? It's a flipper. And so how come that house isn't done yet? As the market, he's watching the market to make sure he gets his money back. Because at the end of the day, Terry doesn't want a property. Terry wants his money. He wants his interest. And so all he's doing is acting exactly like the banker. So I think it's fun when you become the banker, you start thinking very differently and you start understanding why the bank is asking such dumb questions, why they're wondering if you're going to, are you going to flip it? What's the market look like? What's it going to be like in 4 or 5 months from now when that house is flipped? And then, if you're using the other thing is, let's say that you have a house and you're building equity in that home. So you don't sell it every 7 years. Let's say maybe you're the kind of person that, you're going to hold it for 10 or 15 years. Well, you've got equity in that house, right? If you've used your life insurance policy to buy the house, you also, as your house was appreciating, so was your cash value appreciating with dividends and interest. And so now you have two assets that have appreciated and you get to borrow against the equity in your house, or you get to use the equity, the extra dividends and interest in the policy to go buy more property to create more cash flow.
Yes. It's like the perfect and asset. Like so many people say you can't have your cake and eat it too. And I'm like, I'm the type of person, I'm going to have my cake and a cookie. So that doesn't apply to me. And that's how I think about my whole life insurance policies is like, I'm going to have my cake and a cookie. I'm going to, have my equity work for me inside of my life insurance policy and leverage it for, things that cash flow.
Mm-hmm.
So to your point, there's so many, what it really does is it opens up so many possibilities that didn't exist before this process. Because if you zoom out, we're just conditioned to think about either or thinking, right? It's like either I can do this or I can do that. We're not used to and. It's like, okay, I can do this and I can do that, right? I can fund my infinite banking policy and then go make that real estate investment. We kind of combat this a lot, or maybe that's more of an aggressive word than I would like, but we come across this a lot where so many clients start going back to the original either or thinking. It's like, oh, I want to go invest. I want to go purchase this home or this piece of land or whatever the case may be. And it's like, okay, well, why don't you use your policy for that? That's what it's there for, you to use it for investments. Right? So that you can have your dollar work for you, like you said, in multiple places. And I think you do such a great job of breaking that down for people and making it really simple. Because after, as I'm sure you guys already know, listening to Mary Jo for a really long time, you're like, oh yeah, why don't I do that? It's just, it becomes simple, but you have to you have to continuously absorb the information because it is a thought process that is not very common.
Mm-hmm. It's simple when you quit making it so hard, right?
I love
And
that.
it is, I stole that from a client. But it is also something that you have to, like what you're saying, is you have to kind of live in that banker moment. I
Mhm.
just got off the phone right before talking to you with a client that said, "Hey, Mary Jo, we have like $150,000 and we want to buy a rental property." And I'm like, "Okay, how much?" And so we want to maybe move it through a new policy. Okay, when we do that, so if you're listening and you're like, "Oh, hey, I have a bunch of cash. I want to do this infinite banking thing, but how do I move it through a policy really quickly?" Well, if we get $150,000 through a policy, that means we're going to have about probably, let's see, 150. So we're going to have a $60,000 premium every year. That's a bit of a stretch, right?
Right.
And so I'm like, okay, here's the deal. If our property is $150,000, you need all 150. If you put 150 in the policy, you're not going to have access to 150. You're going to have access to about what, 130-ish.
Right.
And so
Pretty close.
if you have, now we didn't leave you with enough money to actually purchase the property. Or if you're going to do an Airbnb with it, we didn't leave you with any money to furnish the property. Well, you're not going to have any guests that way. And this is what I tell people. It's an and asset, but it's not all or nothing. It's not, oh my gosh, I can't put it all in, so I can't do it. No, go buy your property with your $150,000 of cash. But you need to now put your banker hat on and say, what I would have to normally pay the banker back. So if I finance this, so now I'm the banker, I have to pay myself back. How many years am I going to pay myself back? What's at 7% interest? So we figured it out, and her payment would be anywhere between $13,000 to $14,000 a year. Now that becomes her new premium. And we're going to start a policy for the payback amount. So we're going to still get it through the policy. It's just not going to be as fast because we don't have enough wiggle room. We're going to lose a better property that could maybe make us more money, or we had to furnish it or whatever it is. But if we're not putting it all in right away, if it's not all in your policy right away, if you're listening to us and you're like, oh, geez, I haven't got started yet, but I want to do this, you can still do it. It's just, at what level are we going to get started?
What you just laid out is so brilliant because what you're doing is you're recognizing that there is a cost to using your capital, and you are making sure that you are accountable for that inside of a policy one way or another. To your point, it's just how can we do it in a way that's sustainable and conservative and makes sense for what you're going for. So I love that approach. And one of the things that I admire most about you is that you always put your clients' needs and wants first. And depending on what their goals are, you always help them figure out a way to get there in a way that really sets them up for success.
Well, and it's a matter of cash flow, right?
Yep.
Because if we use that money and put it into a policy and they lose access to 20,000 because there's a capitalization period. So we lose access to even 10,000 in the market they're in. That could be the means of $5,000 a year of lost revenue through an Airbnb, because now they had to buy a lower quality home, maybe one bedroom less, and they can't charge as much. So they're not making as much cash flow. So and I heard somebody talk about this on a podcast. They're like, you still get to this destination. It's just how fast you're going to get there, right? We're still going to create the policy. Everybody wants everything overnight, but we're going to have to take some time to get there. I have used cash multiple times to buy things, but then I set myself up for a repayment, and that begins my policy. So,
well, then you're not biting off more than you can chew.
Right.
And I actually have a funny story about this. So one of my kiddos, Kale, he started basketball and he was like so obsessed with these basketball shoes. So he comes home. Obviously, my husband is a much nicer person than me. Regardless of how he may come across, it's the truth. So he lets Kale buy these shoes that are like literally 2 sizes too big for him. And he's like, look how cool these shoes are, Aunt Tortilla. And I'm like, dude, I'm sorry. These shoes are not going to work for you. They're way too big. You are going to injure yourself. I was like, I'm okay being the bad guy if it means that your ankles are safe. And he was very upset, right? And this is kind of like the idea of a policy that's too big for you. It's like, get something that fits. Like,
Yes.
just get something that fits. And so we go back to the store. And so we get shoes that fit him. And I was like, okay, you can still have these other shoes. Let's see if we could get him in a smaller size online. So now they're still too big for him, but he has something to grow into in the future. That's also how I view policies. It's like, get something that fits you right now so that in the future, when you have that cash flow, when you have bigger feet, you can fit that next size up, right?
Yeah, right. You can just get another policy. Like Kale
Yeah.
got 2 pairs of shoes out of the deal.
He did.
And so he started his second pair is going to be when he needs them. And so you just
Exactly.
start another policy when you need it. Right.
Yes.
And we should have a talk with Dano about shoes that fit.
Well,
Dano,
because here's the
dude.
thing.
I can't-
Kale he's going to be my little salesman because he will talk your ear off and find all of the different angles as to why you should get him exactly what he wants. And I'm just more hard-headed than he is. So I'm
You're
like,
more
listen,
clever. More clever.
yeah, I'm like, you're not pulling one over on me, dude. So
But,
I was
but
like,
let's go back to Kale's shoes for a minute. So you have your policy, right? And it's working at maximum capacity when you fill it. If
yes.
you don't fill it, it's not working as good because it's not been structured correctly. So I would much rather start a smaller policy that you're filling up and it's being utilized correctly than a policy that's too big. So some agents may say, oh, well, Trissa, that's okay, Aunt Tortilla. That's pretty funny too, Aunt Tortilla.
Yeah, that's another story.
Aunt Tortilla, let's get you a policy that's, you can put $3,000-$4,000 extra in there if you have it. Well, I do know something about life and it happens. And we just don't know what's going to happen. Is the 5,000 extra going to come or is it not going to come? So Nelson always wanted us to wait for a windfall, right? Oh, you got money there to wait for a windfall. Well, I'm not that hung up on windfalls, Nelson. Okay. When it comes to me, I'm not going to count my eggs before they hatch. So when it comes to me, we're good. I'll start another policy. But until then, I think we're just going to be conservative and stay where we're at, get your feet wet, figure out how to use it. You can start another policy in 3 months if you want. Nobody cares. And I've had people do that where they're like, oh, Mary Jo, I can't start one that big. And then they'll come back 4 months later and they're like, oh, hey, I didn't get that land deal that I was looking at, or I wasn't able to rent that land I wanted. So now I have all this extra money. So I'm just going to start a policy with it. Okay, good to go.
Right.
I do want to go back, though, to what we were talking about for the infinite piece of it, because I think that is very clever to be, and I don't know if you were that clever on purpose, but to play off of infinite banking, right?
Mm-hmm.
Like we can do an infinite number of things with this policy, but it just relates very well to that comment of property can be turned an infinite amount of times. Banks make money an infinite number of times by turning money, turning real estate, turning whatever. You have that same infinite opportunity inside of the life insurance policy because that money can be borrowed and paid back and it's in there earning compound interest and dividends. And you can start however many policies your human life value or business partner relationship or key man people you have.
Yep.
So I love that. I think that everybody just like we kind of got off track, but I think everybody needs to marinate on that just a little bit, that it is mind-boggling to think about the fact that banks can do an infinite number of turns on one piece of property over the lifetime of that property, which is a bazillion years. Right.
Yes, because even if the house breaks down, they can still sell the land. And
right.
I think what it does in thinking about it like that is it makes you realize, like, if you're just thinking like an investor or you're just thinking like a business owner, you are touching a very small piece of the pie. If you zoom out and realize how much money the bank is making on all investor activity, all business activity, all consumer activity, they are winning every single year, year over year, in such a big way. And we have access to be able to participate in that winning right at our level with shoes that fit, with a policy that fits. And we can take back some of that power and that profitability. And I just love that idea so much because it just, like I said, it expands what's possible.
But we can take it back on two levels, really. We can take it back on the level of us buying our own real estate and selling our own real estate and running that through a policy, but we can also take it back on the level of lending money or owner financing real estate and sell it that way.
Yes. Okay, so dive into that idea a little bit more because you do such a great job of strategies and I love learning from you. So I think people need to.
Well, I think it's pretty typically I'm talking about farm ground and there's just not a whole lot you can do to destroy farm ground. I mean, you can. It's pretty hard. But with a house, people have, or a commercial building or something like that, there's a little more hesitancy to do an owner finance because someone could come in and destroy the home. But I have a client that they owner finance. I think they have about 15 homes. Last time I talked to them, they had about 15 homes that they were owner financing. And they buy these houses, they rehab them, then they owner finance them. They ask for about $10,000 down. It's about a $125,000 home, something like that. Ask for $10,000 down. When interest rates were 4%, they were financing these homes at 8%. Nobody ever refinanced that house. They just kept them with them. And now, probably not such a bad deal, because they're about where they're supposed to be. But they only ever got one house back that had a hole in the wall about like this. It wasn't even that big of a deal. But because people have some money in the deal as a down payment and they have ownership of it and some pride, most of them don't want to destroy it. But there is that risk of destroying it. And so when we're thinking about, we can use our policy to buy our own real estate, because we owe the policy money, let's just say that we've borrowed $150,000 from cash value against cash value. We've borrowed $150,000 and we have this home paid for, but now we want to sell it. If I want to sell it to you, I can sell it on whatever terms I want because I don't owe anybody anything except myself. I can decide how long I'm going to lend you the money to purchase the home. We can amortize that however we want. We can set the agreement however we want. We don't have to ask permission of anybody. And here's the other thing. I just had this happen with a client that bought some commercial property. The guy that was selling the property wanted $100,000 of the $200,000 he was selling the property for. So he wanted $100,000 so he could put it on his new property to help with his payment. Okay. Chances are, if you're selling a $200,000 property, you probably bought a property that was $500,000 or more, and it was kind of an expensive property. So I'm guessing he was upwards of $500,000. Well, when you think about it, an amortization schedule does not change much over 25 years if you put an extra $100,000 down. Like it's going to be a little bit of money. I said, well, why doesn't he just owner finance you guys? Your payment to him, it was going to be about $1,300 to $1,500 a month. I said, if he wants cash flow, he is going to get $1,500 a month from you, and he can apply that to his new mortgage. Like, you are not going to give him $100,000 and that's going to reduce his payments by $1,500 a month. It's amortized out too long. It's not going to happen. And I said, plus he earns the interest. So instead of it being a $200,000 property, it turns into a $400,000 property if he finances you over 30 years. So they went to him, they offered, originally he said, no, I don't want to do the deal. And then I said, take him the numbers and show him the numbers. So they went back, they showed him the numbers. He's like, yep, I'll owner finance you. Sounds like a good idea. And we can refinance it in 5 or 10 years so they can go to the bank. In 5 years, their interest alone on that loan was about $13,000 or $15,000 a year. I would have to look at the numbers. He was going to make, maybe it was 15. I think it was 15,000 of interest a year. He was going to make $100,000 of interest in 5 years because all the interest is coming up front. And then it lowered his capital gains. So he wasn't having to pay capital gains on the full amount right away, all at once.
Mm-hmm.
And so, I mean, we have to run that strategy. We're going to do a whole podcast on that, but I want to run that strategy with an accountant to do like the pros and the cons of it. But people don't understand that they can owner finance. And when you own something and you don't owe anybody else money, you can do whatever you want with that property. And people do not understand that they can do that, or they think it's too much risk. If you double your money, if you can make another $200,000, do you think you could go to an attorney, have them draw up a contract for deed for less than $200,000?
It's too expensive, Mary Jo. Just kidding.
That's exactly what people think.
I know,
though, right?
I know.
They're like, so
yeah.
that is the exact mindset, is it's too expensive, I don't like attorneys, and it's too risky. Well, if it's too risky for you, then don't ask the bank to stop asking stupid questions, right? The bank is asking stupid questions of you and putting criteria on you because it's risky. So you either take the risk or the bank takes the risk. But don't be upset when the bank tells you no, because now you understand their risk.
Mm-hmm. Well, and in my personal viewpoint, it's less risky because let's say something happens and they have to, take possession back of the property. They can always choose to sell or finance it again. It's like you could do unlimited transactions. That's why a lot of real estate investors really like the lease option, because you can still get that initial chunk of money.
Mm-hmm.
And I think it's like 70% of lease option payees don't end up purchasing the property, even though they have the option to.
Oh.
And they take better care of the property than a regular tenant would, and they're paying more monthly. So,
yeah, I actually talked about this on my Farming Without the Bank podcast. I got a email from a farm credit lender, and he said, Mary Jo, there's risk to owner financing. And he sent me all of this 80s information that said, well, there's risk here because land values dropped in the 80s, right? So we could compare that to the 2008 crisis where all the housing values went down. And so now apparently the seller had to take less for his land. I'm like, well, first of all, that's stupid, because why would I be taking less for my land? It was a contract. It's not renegotiable. But if you didn't have that in the contract, this is good information. So I emailed him back and said, thanks for the information. I'll make sure to share that with my listeners, that if they do a contract for deed, they should consider that and put that in their contract to protect themselves from it.
Oh, from like purchase price? Is that what you're talking about?
From like the price of the house dropping. So let's say that I sold you a $500,000 house, but now the economy crashes and the house is only worth $200,000. What he's saying is you would only have to pay me $200,000.
Oh, heck no. No, you definitely get that in the contract.
Right. But apparently this happened in the 80s, So he's trying to tell me that you should go to Farm Credit and you should go to a lender because it's too risky for a person to do owner finance. And I'm pretty sure that was his point, is, owner finance isn't great for everybody. And it's not great for everybody, but there's risk to owner finance. Well, okay, awesome. I understand the risk. I appreciate that. And I'll go back and tell people to look for that risk. Yeah. But I'm not going to say don't owner finance because of that.
That's kind of a silly point. Right? It's like, well, then your contract was messed up from the beginning. And that sounds like a ish you, not an ish me.
Right? I found it a little bit, I appreciate the feedback.
Right, yes.
But I found it a little bit comical. Like, as a lender, are you concerned that I'm telling people not to use the bank, like to owner finance, because you're going to miss out on a little bit of interest? Like, it's little old me out here with my little old podcast, and you're concerned about one podcast that I might steer a couple people away from the banking system. I'm pretty sure with the 30 million Americans in the US, like, I'm not going to hurt the banking system. I'm pretty sure I can't do this single-handedly. But if you think I can, I truly appreciate the confidence.
Right. You're like, this was actually the biggest compliment ever.
Yeah, I thought it was pretty good. We're going to have a whole nother podcast on that. My agent Amber, that's an auctioneer and used to be a realtor, and she's in that world. She's looking at it all. So it's going to be fun to have her on the Farming Without the Bank podcast to talk about it. But is there risk to owner financing? Yes. But if you own that home and you have a loan through your policy, you get to do whatever you want with that home. Nobody is going to tell you differently.
Absolutely. Well, and I always like to think about, well, what if? It's like in your client's case, that guy was like, okay, I need that chunk of money to put down. And it's like, well, if you zoom out and look at the big picture, which I think you do a great job of encouraging people to do, it's like, how does this action affect the big picture? Well, he's going to have that chunk of money to lock up in his next property, and he's going to have a higher payment. Whereas the seller finance route, he has higher cash flow every single month, which impacts his payment more than putting $100,000 down. Like, that is such a great way to put it, is if you zoom out and look at the big picture, you have the opportunity to make so much more when you think like a bank, because banks make so much money. So if you just try on that thinking and realize why banks are so happy to lend money if you can make payments, then just apply it to what you're already doing. We're not doing this currently, but my husband had a work truck, and so we were thinking about potentially seller financing like our second vehicle. So it's like you can apply that type of thinking to everything. And if you look at how much interest banks make over the life of a loan, it feels like a lot more than 8% or whatever it is, you know?
Yeah. I think you also have to consider the fact that, and this kind of irritates me a little bit, the banks they're regulated to a point, right? But the banks can lend money. They can do whatever they want. Credit card companies can do whatever they want. But then we come in as people and we're like, oh, no. You can't charge X amount for interest. You can't do this. You can't do that. What? Why can they go do it? Why can payday people lend money at 30, 40% interest if that's what they're doing? I mean, it's just crazy. And so don't tell me what I can and can't do. That's not going to go over well with me. I'm just going to do what I want to do anyway. Well, I think that is a good note to end on. Thank you all for listening. Teresa is going to be a regular on here, I think. So it's nice to have somebody to go back and forth with, as long as we can get some time scheduled to get her on. That is our biggest hurdle between her schedule and my schedule. But thanks for listening. If you guys have comments, questions, concerns, maryjo@withoutthebank.com. If you want to email Teresa with anything, it is teresa@withoutthebank.com. And if you need to make an appointment with either one of us, just, go to the link if you have it. If you don't have it and you've read the book, you can email maryjo@withoutthebank and we will send you the link, or you can call in. But otherwise, if you don't have the book, get it and have a fantastic rest of your day.